last class we had completed with the Exim Bank introduction, features and the functions, right? So today we'll be looking at the last part of the fourth unit called as mutual funds. Let's look at the meaning. A mutual fund is a company that pools money from many investors and invests the money in securities such as stock, bonds and short-term debt. The combined holdings of the mutual fund are known as its portfolio. Now remember, in simple, what is mutual fund is. Now, in case we want to have some kind of investment, we want to have some kind of savings for our future, right? And we would look out for investment avenues. Now, even though you don't have much money, maybe even starting from 5,000 rupees as savings per month, right? Mutual funds is pooling of many investors. So even though you can save 500 rupees per month. I think that could be the minimum per person in today's economy. Per month, if you can save 500 rupees and invest that in mutual funds, that would be very beneficial. So what does this company mutual fund do? Mutual fund collects like you. Now you are one person investing rupees 500 per month, okay? Likewise, there are going to be another lakhs of investors who are giving same 500 rupees, or let's say even 400 rupees, okay, even lesser than that. Like that, they're going to collect smaller amount of money from large number of people, that is many investors. What do? They collect all this money from various investors. They invest this money in securities. Okay. Now, if you as an investor want to trade on share market or want to invest elsewhere, you need to follow up all the legal procedures, open demat account, all that you need to understand, appoint a broker, if not all that, right? This is more simpler option. Okay, it's just small amount of your savings. Okay, along with you there are going to be other lakhs of investor with small amount of money pooling into one company, and this company, now 500 into another 10 lakh people, it might come up to even 10 crore, it might come up to 50 to 80 lakhs. This 80 lakhs of complete amount, they will divide and invest in few in shares, few in bonds and few in short term debt. Okay, so this combined, so this entire 80 lakh, let's say that's my total collection of amount. I will not invest only in one avenue, let's say in share market. No, if share market crashes, entire money is lost, correct? So here what we do, that's why it's called as portfolio. It is an amount of money that is put into diversified investment avenues. So in that 80 lakh, let's say I put 30 lakh in bank. Let's say put another 30 lakh in debenture, another 20 lakh in share market. So what am I doing? I am diversifying my amount of investment. So this method is called as portfolio. Is that clear? Hope you've got the meaning. So here is a picture of how mutual fund works. So you can start with the top investors. Can you see that on the board? On the screen, investors, they pool their money, collect money from all the investors. So there is called as a mutual fund manager, commonly called fund manager. What do? They invest in securities. As I told you, just explain, share market, bond, banks, LIC, any other, right? Any kind of investments. What does that investment generate? Returns. And that return is again given back or passed back to investors. Just take a few seconds to look at this picture and understand how exactly this mutual fund works. So as an investor, what is your benefit? Your investment or your savings is very small, okay? But for this small savings, if you have to individually go and invest, you need to go through a process of lot of legal formalities. But if you as an investor with small savings go through this company called as mutual fund, it will save you a lot of time and effort. automatically it also will give you a benefit of timely returns. Is that clear? So it starts with investor, the money moves to fund manager, the fund manager invests the funds in various securities, the securities will generate returns, and the returns are passed back to the investor. Is that clear? Hope you have understood what is mutual fund and how exactly does this concept work in reality. So next up we have, this is a section C question. Okay, it's a complete section C 15 marker question. Explain the classification or types of mutual funds. Either ways it can be called types of mutual funds or classification of mutual funds. So today we have under this classification we have three different categories. One is based on execution or operation, under which we have three different categories types: open-ended funds, close-ended funds, and interval funds. Part B is based on investment objective. So what is your objective when you're investing your money as an investor? What is your objective? You have income schemes, growth funds, balanced funds, tax saving funds, sector funds, specialized funds, gilt funds, and money market funds. These are 8 different types under the category B. Category C, we have based on geography. That is one, domestic schemes, and second, offshore schemes. So these are the three different classifications of mutual funds, a very, very important topic. So today we'll be discussing the part A, category A, based on execution or operation, and part B will discuss maybe 3 points under category B. Okay, let's begin. Based on execution or operation. So the first one here is close-ended fund. What do you mean by, okay, so what is this classification? Is execution or operation. So in a particular unit or a mutual fund operation, how does it work or how does it operate? Based on this classification, we have three different varieties of mutual funds options. Option 1 is close-ended fund. As the name itself says, under this scheme, the corpus, that means the total capital. I just gave you an example, right? I'm collecting 500 rupees from every single person. So that mounts up to almost 80 lakh rupees. That 80 lakh rupees is called as corpus or capital of the fund, and its duration are prefixed. So two things I want you to remember. Under close-ended funds, the capital is fixed and the duration of the fund is also fixed. Capital is fixed, duration of the fund is fixed. So once the subscription reaches the predetermined level, the entry of the investors is closed. For an example, I say 80 lakh is the total capital of this mutual fund scheme, and I tell the time period to complete this scheme is 3 months. Okay, so what am I fixing? I am fixing the corpus rupees 80 lakh. I am fixing the time period of 3 months. So once this advertisement or promotion of the scheme is public, people are welcome to invest. How far? So one can invest 1000 rupees. So there is no particular limit. One can invest 1000 rupees, one can invest 5000 rupees, and if your only savings is just 500 rupees, yes, you are also welcome. So like this, all the money gets collected and gets piled up. By the time 80 lakh is reached, okay, let's say the number of investors in the scheme are just 200 investors. The scheme gets closed. Okay, by the end of 3 months, 80 lakh is reached, the scheme gets closed. So now, once the time period is, duration is ended, even if you want to contribute towards that scheme, you cannot. Because why? The scheme is closed. That's why it's called as close-ended scheme. Understood? Let's understand the features of the close-ended funds. The period of the target amount of the fund is definite and fixed. As I just told, for an example, 80 lakh in 3 months. I am prefixing it or predetermining it. Once the period is reached or over, the investors cannot purchase any more units. So, in company, if you want to be a part of the capital, the company calls you as shareholder. Likewise, in mutual fund, if you want to contribute towards the capital, you are called as unit. You have to purchase the unit. Okay. So once here the predetermined time period is completed, you cannot, or as an investor, you cannot purchase any more units. These units are publicly traded through stock exchange. As I told, whatever money you're pooling in through this scheme is of course traded on the stock exchange. The main objective of the fund is capital appreciation. Okay. Now here we are focusing on capital, providing capital towards the company. Capital is supposed to be appreciated. At the time of redemption, the entire investment of the scheme is liquidated and proceeds are distributed among the unit holders. So how does this work? As I told, right? For the period of 3 months, have collected 80 lakh rupees, and I tell the time period of this entire mutual fund scheme is 2 years. Okay. So for 2 years, the mutual fund company uses the entire capital of the scheme, try and invest in all possible investment avenues, make enough return or generate enough income for what? In order to redeem it at the time of end of second year and then liquidate. Liquidate means what? You have already studied about companies liquidated, correct? Companies closing down. Likewise, even this fund comes to the end. After when? After 2 years, the scheme comes to end, and whatever returns or income the scheme has made, accordingly it will start distributing to unit holders. Now, I already told you what is unit holder. For a company, it's called a shareholder. In mutual fund, you are called as unit holder. So, if your contribution is rupees 5,000 in this particular scheme, accordingly your return will be there. Let's say you have earned 1,000 rupees more. You invested 5,000, you got back 6,000, 1,000 rupees extra. Let's say I invested rupees 500. Okay. So, after 2 years, I am getting 70 rupees extra. So, 570 is my return. So, depending upon individual contribution towards the scheme, your return or income will also differ. Is that clear? So, that's called as the close-ended funds. Hope you have understood the concept and the features. Point 2 is open-ended funds. It is the opposite of close-ended funds. As we just studied what is open-ended, right? What is the primary feature over there? Time period and capital are fixed. Over here, it's not. That's why it's called as opposite of close-ended fund. Under the scheme, the size of the fund or the duration are not predetermined. I just mentioned to you. In close-ended, both these options are mentioned or prefixed. Under open-ended, it is not fixed. The investors are free to buy and sell any number of units at any point of time. So previously we had a time limit. If you want to be a part of the scheme, you have to purchase within that time period. Okay, within that time period. So otherwise you cannot purchase. But here in open-ended, there is no such limitation or no such restriction. You can purchase or sell any number of units at any point of time. The third type here is interval schemes. Basically, it's a close-ended funds. It has a special feature that every year for a specific period, the scheme is made open. Now, usually when do we call as an interval? As a break time, interval period or a break time, correct? Likewise, even for a mutual fund scheme, as I told, the scheme time period is, let's say, 2 years. 2 years is the duration. Duration is 2 years. Now, here what I do is interval scheme. In those 2 years, Now, especially there is certain cultural beliefs that we have in our society, right? Certain month, we can generate more income, etc. There's just that belief. So based on that belief or based on that practices, they can keep, let's say for an example, month of July and month of December. Okay, month of July and month of December, I will give a break. Okay, so until January to June, it is close-ended fund. Got it? From July 1st to July 31st, it becomes a break. That means Jan to June, it's locked. Nobody can again buy or sell units, right? You have to abide by it. Again, in that 1 month interval or break, again people can exit out of the scheme or again join back in the scheme. During what? That 1 month interval break. Again from August to November, again it's locked. Again you neither can purchase extra or sell. You just have to stick with the scheme. Again the last month, December, again it keeps open, called as interval. Again if you want to sell the units or purchase units, again the time period is given in the month of December. Is that clear? So this is called as interval scheme. So on an overall, it is a close-ended scheme, only that it has small breaks or intervals in between. Is that clear? So this is the third point, that is interval schemes.